What's up, everyone, and welcome to the daily macro update for Monday, January 12th, 2026, the day before the inflation report. Tomorrow morning at 8:30 a.m., we're going to get the December CPI inflation report. Now, the November CPI that came out in December was pretty much distorted. A lot of critics were saying, hey, it was incomplete. We didn't get all the data due to the government shutdown. And so that huge decline that we saw, I think it was like, what, 2.7%? That was incomplete. And so this print that we're going to get tomorrow is going to be a little bit more clear only because we're going to have more data, right? And so I think what we'll probably be looking at more so is the month over month data because the year over year might be a little bit distorted from the months that were taken away. But in any case, it is going to be a more clear picture. And the market right now is pretty much betting that it's going to be a hot print and that we should go back into, being a little bit more hawkish when it comes to inflation. But what's interesting is that completely goes in the face of all the different leading indicators that we've been seeing. And so my team and I have been taking a stance to fade a lot of these narratives that are saying that we're going to get a hot print. And so, even if it comes in at expectations or even below that, I mean, I think that we'll see a continued upswing on things that have been having a little bit of a pullback and have been starting to show a little bit of strength, such as Qs, some of the mega caps, as well as things like cryptocurrencies. So that's what we will be going into today on the live stream. If you guys haven't already, go ahead and hit subscribe, share with a friend who wants to learn more and incorporate macroeconomics into their process. We cover this every single day. We go live Sunday through Thursday. During the week, it's every day at 3:45 p.m. to catch the close. And we go over the most recent macro developments in the context of positioning in our portfolios. And also, too, right now we have our, if you want to check out our website right now, we have our two services that you can check out here. One is our membership, the other is the partnership circle. The membership is only $15 a month. You get our complete list of top 25 ETFs as well as top 10 stocks for the trends of those, as well as you get trading ranges for the week on things like Bitcoin, gold, silver, the dollar, and a bunch of other really good stuff in that weekly report that comes out every single Sunday. And you also get access to our 8-chapter macro investing training. So go ahead and check that out there on our website. And so going into this week, we did a complete breakdown of the thoughts going into this week on last night's Sunday macro wrap up. So make sure you go to our YouTube channel and check us out there and watch that live stream. A lot of people don't know, but when you go to our YouTube channel, you have to click on the live tab. And so just make sure you do that there in order to see the most recent videos. I don't have time to do custom videos and have an editor and stuff like that. So we're going to stick with live streams. And so, yeah, I mean, when taking a look at the market pricing in for tomorrow, it seems like there's a lot of crowding into a hawkish sentiment. And so we'll be taking a look at some of the indicators that are making our team to believe the contrary. But when taking a look at the previous CPI print, right? So we had that big gap for the October print. We're never going to get that data. It's kind of just lost. But it came in at 2.7% for headline, and the core CPI went all the way down to 2.6. And so what we do think is that inflation is going to still continue to be somewhat muted. Maybe it's not going to resurface up to 3%, but I think that it's going to continue to trend downward. Only because when you take a look at something like the rate of change of 5-year break evens, you can see that this continues to show that it's going down. Let me just change this to a line. So zooming out on this, ever since really the peak that we saw back in July of last year, this has been in a downtrend. Since the start of the year, though, it has had a little bit of a rebound, but this pricing is not going to be in the December data. Pretty much for the month of December, this continued a downward trajectory. And then also, too, when you take a look at the rate of change of something like oil as well as natural gas, both of those continue to decline in December as well, right? So, we think that the market is a little bit off sides here and that there's a higher probability that tomorrow's print could be either in line with expectations or even down from expectations. And so, um, yeah, seeing that, we still think that the Goldilocks trade is in play, and this will also affect the target rate probabilities for the March and April Fed meeting, which at the timing of this recording, they have the first Fed cut being in June of this year. And that if it comes in lower than expected tomorrow or near expectations, that could be pushed up to either April or March. The Cleveland Fed CPI nowcast is suggesting that it's going to come or stay in line with 2.6%. We'll see if that happens. But when we take a look at the previous market report, you can see here how the columns for October and November are pretty much blank. And so we're going to be getting a lot more data here with these being filled in. But we also saw that there was yields spiking, mainly, due to the whole announcement from Trump saying that they're going to put a cap on credit card yield, which I'm not sure how legal that is, but yeah, that was lifting up yields, and really the biggest performers have been some things that are that have been going down a lot, such as natural gas. So yeah, we'll see what happens tomorrow, but I wouldn't be surprised if we get a pretty decent reversal from what we've seen over the past few trading days to start the year. So we'll see what happens though. Let's see. Taking a look at the S&P 500 ranges for today, we have about 5 more minutes left in the market. Let's take a look at it. Yeah, so it looks like the S&P is about to close on another all-time high yet again on slightly decelerating volume. So today's a pretty good day to take some profits and raise some cash ahead of the CPI print. Normally ahead of these major event, news data releases, I like to de-risk a little bit, especially when things are at the top end of the trading range on lower volume, just in case you get some type of weird reaction where you do have a slight correction. You can go ahead and buy the dips there. So good time to take some off the table there. But what we can do is we can get into some questions. It can be a pretty short live stream for today. So welcome everyone. Appreciate everyone for joining. Yeah, we have some other developments from the team as well to go on our websites. We want to produce an entire one-stop shop macro dashboard for everyone to look at. So that's going to be coming here in the next, hopefully, few weeks. And that'll be pretty exciting there. Look at consumer staples over the past couple days. Huge acceleration. Same thing with industrials, materials, consumer discretionary. Yeah, pretty interesting moves here going on in the staples sector. That's usually a risk off type of signal, so we'll see if that sustains after tomorrow's print. Bitcoin having a little bit of a bump today. Nothing too crazy, but on a technical sense, this does look like it could potentially have a breakout here. We'll see. Can you check your model for the ticker FORM? Not sure what this is. Form factor. Definitely in bullish trend. Not really sure what this company is though. Okay, semiconductors, $5.65 billion market cap. Yeah, it's pretty small. It's above 5 billion, so it's something that I would take a shot at. But yeah, I mean it's well above the top end of the trading range. Probably wouldn't be buying it or chasing it here, but it's definitely something that's in bullish trend and to add to the list in order to buy dips. But yeah, it's bullish. Yeah, biggest movers for today. Silver miners, gold miners. These things have been ripping. Not really any slowdown in that sense. Correlations versus the dollar are pretty interesting right now. We're seeing a little bit of a climb in negative correlation from things like precious metals, gold. They're getting less oppositely correlated to the dollar. You still have something like Bitcoin that's positively correlated. That's pretty interesting. When we zoom in on a 15-day basis, let's see here. We can see that pretty much everything went from, negative correlation just from 1 week ago, and you can see now it's getting more positively correlated. So that's definitely interesting there. See how like 1 month ago it was bright red on the correlations versus the dollar on a 15-day basis, and then from 1 week ago it got a little bit less negatively correlated, and now it's kind of had a flip. Right, you've had the 10-year bond go from, I guess you could do this actually. Instead of IEF, let's do the 10-year bond yield. There we go. Yeah, so essentially everything is becoming more positively correlated to the dollar on a immediate term basis, which is interesting. Meaning that, if the dollar continues to strengthen from here, we might not see too much of a impact on a lot of these major assets. Sometimes a strong dollar doesn't necessarily mean, or a dollar that's having a move upward in the short term, doesn't always have to be automatically bearish for the markets. Bond volatility still remains low. Equity volatility still remains low. I'm not really seeing any type of crazy um, risks in the market currently, as well as credit spreads remain incredibly low. So take a sip of water here. Gold is screaming. Yeah, I mean, gold has been on our list here for quite some time. So I mean, this remains a clear bullish trend and a pretty decent sign that we're in an environment that is even though the yield curve is having this steepening, um, you're not having the market sell off, which is a little bit of a change from what we saw this time last year. But yeah, so that is interesting. We continue to get that twist, and it almost looks like now that this twist is doing more of a bear steepening twist. And so if we bring up let me see if I can bring it up here. Let's go to, all right, so let's zoom out a little bit here. Okay, so a bear steepening twist. This is where you could have a more of a larger pickup in inflation over the trending term, but this is where 10-year yields are rising more than 2-year yields are falling. And so you get a anti-parallel yields in this type of twist scenario, which is what the yield curve is signaling. Unsustainable spending from the government becomes debt concerns. The Fed is behind the curve, reluctant to hike rates. The dollar continues to fall as there's more of a sentiment of a loss of purchasing power, get the heck out of the dollar. Things that do well, hard assets, real estate, gold, and crypto, still, waiting a little bit on that crypto component. But things that typically do poorly are the dollar, bonds, cash, and financials. Yet financials are doing good right now. So it's almost like crypto and financials are switching spots here. But this isn't like hard set in. You always have to see what the actual market is signaling, but that's just typically what happens. You could always have some nuance there. But that's really what it's signaling, And if we end up going into a situation where we get more of a bear flattening, then I would probably be thinking about selling some more here. And it almost looks like that's what the 1 week and 1 month trend is showcasing, this bear flattening. And we'll see what happens on a 1 month trend basis. But the bear flattening that the 1 month performance is suggesting is more of a traditional type of bear flattening. And this typically happens when you have strong growth, but inflation forces the Fed to become more hawkish, right? Um, but this would also infer that the government the government is going to back off a little bit on their spending, which I don't see that happening. So we'll see if this continues. But if we do end up going into this bear flattening scenario, then that typically is not a good environment for things like tech stocks, Bitcoin, long duration bonds, real estate, and it's good for the dollar, short term treasuries, that sort of thing. So it's kind of teetering on that, you know, and we'll see what happens from here. This document right here is something that my team and I created. This is our thesis on our yield curve phase signals. For those who are in our macro investing community, you guys have access to this, and I am thinking about. I updated it over the weekend, but I am thinking about doing a dedicated live stream for this on Friday. I'll have to see what my schedule is like, but I definitely want to go over this for the community in greater detail because it's something that in this financialized market is going to be more and more important. Thoughts on BDRY? Yeah, so I mean, dry bulk shipping typically does well with, inflation accelerating if it's supply side inflation, which it has had a pretty decent acceleration throughout the month of November. But ever since the beginning of December, it's had a little bit of a correction and has been losing some trend. Um, so this would really be more of a neutral trend. I'm not necessarily doing anything with BDRY. Why would it sell off if we think the printing is soon? You don't want out of assets, you want out of USD, no? Well, it depends on, the context of the reason why they're printing money. If they're printing money in an emergency because, the market is crashing, then obviously, even though they're flooding the market with liquidity in that instance, you do not want to be in risk on assets because typically those things are doing poorly, right? But if they are doing what they're doing right now, which they are holding off on Q, or they stopped QT and they're actually doing kind of like a QE light where they're starting to buy treasuries, but they're focusing on the short end in order to help out the government with that debt burden. So it's like a slow drip instead of like I don't know how you would call it, you know, it's like sipping on something instead of taking a shot. $10 trillion of debt needs to be sold. Yeah, I mean, they can always just roll it over. So if the market has the capacity to continue to roll over that debt, then it's not really going to be a huge issue. Silver has been giving better returns versus gold. Yeah, I mean, both are in bullish trend, but you're totally right. If you take a look, and you can do this with any two assets, but if you take a look at the ratio between silver and gold, you're absolutely correct. You know, silver has been really accelerating versus gold over the past month and a half. You did start to see this bottom out back in April of last year, and then all of a sudden, starting in May, gold or silver really started to gain strength versus gold. And you can see that pretty much from the beginning of June all the way until middle of November of last year. And then all of a sudden, the Santa rally was in silver. So you had a huge acceleration and it's continuing. So this is definitely more of a signal of fiscal dominance. Um, when you have these, precious metals doing this. So it is interesting seeing that there. How is the IDX Indonesia ETF looking? I don't know. Let's see. Yeah, I mean, it looks like it's been losing a little bit of strength here, but still remains bullish. Yeah, it still remains in bullish trend, but it has lost a little bit of strength. So, but yeah, emerging markets have been doing well. All right. Well, we're going to go ahead and end it there, everyone. I appreciate everyone for joining. Again, if you want to check out more about how we are staying ahead of the macro shifts and you want to get more access to some of the specific signals from our model, you can go to our website here and check us out and read more about it. But I appreciate everyone for joining. Good luck out there, and we will catch you in tomorrow's daily macro update. Bye, everyone.